Hi, everybody. It's Peter Schiff. It is Monday, April 7th, 2014. On Friday, we got the highly anticipated March non-farm payroll number, and everybody was looking for a big number. There was talk of 250 to 300,000 jobs that were going to be added in the month of March. After all, the weather was warmer in March than it was in February, and the consensus was the main thing that was restraining employers was the temperature. But as the weather warmed up, they were no longer frozen in a non-hiring mode, and people were expecting lots of new jobs in March. Of course, those who were looking for a strong report were disappointed because we only created 192,000 jobs in March. In fact, when you take into account the upward revisions to February, we actually created fewer jobs in March in total than we did in February, despite the warmer weather. In fact, we actually lost manufacturing jobs in March. We added some in February, but we lost 1,000 in March. So the manufacturing sector considerably weaker despite the improvement in the weather. Of course, weather was never really a factor. It was only a factor in the minds of people who were looking for an excuse to explain away the weak data. Of course, all of the other data points in the report were weak. The unemployment rate held steady, even though the participation rate notched up ever so slightly to 63%. A few 100,000 more people left the labor force. We had another increase in part-time or temporary work. In fact, almost all the jobs added were of a low quality, part-time, service sector, low-paying type jobs. In fact, when the Obama administration was bragging on Friday about the fact that now, because of these jobs that have been added in the first quarter of 2014, that supposedly all of the jobs that were lost during the Great Recession have now been reclaimed, so that we can all congratulate ourselves or the Obama administration on the job well done, because we have regained all the jobs that were lost. Of course, that hasn't happened at all. And number one, there's been a big increase in the population. A lot of people have graduated from college and high school who were still in school when the Great Recession began. We haven't created jobs for them. In fact, the jobs that we have aren't even near the caliber of the jobs we lost. I mean, if somebody lost a high-paying job with good benefits and now they have a low-paying part-time job with no benefits, that's hardly an even trade. Yet that's all the president is focusing on when he just looks at the numbers, because a part-time job at McDonald's still counts as a job. Even if it replaces a full-time job at a manufacturer, it's still a job as a job if all you're doing is adding up the numbers. But if you're looking at the earnings or the standard of living that a worker is able to enjoy as a result of that, we are nowhere near where we were at the beginning of that Great Recession. In fact, we're in a much deeper hole if you look at all the other measures of the job market. Yet, of course, that doesn't stop the Obama administration from, trying to declare some sort of hollow victory. Now, the markets, it was a different story. The markets reacted very negatively to the bad news. And this is potentially significant because we have been in an environment where bad news was good news, meaning that bad economic news meant the Fed was going to be a bigger player, that maybe more QE was coming, or that the Fed would be slower to remove the punch bowl if the economic numbers were weaker, and so that's good for stocks. So we were in a market environment where bad news was good news. But now bad news was bad news. And that might be because you have a lot of stocks, particularly in the NASDAQ, where you have very, very high price-earnings ratios, where lots of earning growth is assumed in order to justify the valuations. But that earnings growth cannot be achieved if we don't also have economic growth. And maybe these nosebleed valuations in these momentum stocks are catching up. And now that traders are starting to look at disappointing economic numbers from a different perspective. Sure, the Fed might be in the game, but maybe the game is changing because the earnings won't be there. Maybe the money printing will, but the earnings won't. And stocks start to sell off. In fact, the NASDAQ was down about 110 points on Friday. The Dow, which was stronger for most of the day, succumbed to the weakness and closed down triple digits, down I think better than 150. Again on Monday, same pattern. NASDAQ leading the way down. Both the NASDAQ and the Dow opened stronger on the day. They rallied in the morning, sold off, and then closed on the lows. Another triple-digit loss for the Dow, about almost 50 points again for the NASDAQ. Getting close to some very critical support. I think the NASDAQ around 3,900 to 4,000 is very key support. We close below 3,900 in the NASDAQ. It's a whole new ballgame. I mean, it's going to be, it's a long way down, I think, for the NASDAQ. It might be able to get closer to 3,000 were that to be the case. Now, if we're now in a situation where bad news is bad news and good news is bad news, what kind of news can the market get that might change its direction? And I think that's going to come from the Fed. Remember, the Fed is talking taper only because it believes that it has a recovery in motion that can withstand not only the taper, but ultimately an increase in interest rates. But the entire phony recovery is built on the foundation of the wealth effect. The wealth effect is the added consumer spending that comes from higher stock prices and higher real estate prices. Now, of course, unlike prior bubbles that were enjoyed by a larger percentage of the population, it's just the very rich who have been the beneficiaries of this wealth, and that's why the spending is concentrated on high-end stuff, whether it's high-end consumer goods or high-end properties. But if we start to see a decline in the stock market, and we're already starting to see weakness in the real estate market, now the wealth effects are going to be operating in reverse. You're going to have falling asset prices, reverse wealth effects, and now whatever recovery the Federal Reserve believes that it helped create is going to vanish before its eyes. The only solution for the Federal Reserve is going to be to taper the taper, meaning pause the taper and then ultimately reverse it. That is coming. Now that we've got the March data, right, that wasn't much better than February. In fact, it might have been worse based on some measures. We're going to get more data coming out in April, May, June. All of this data, I think, is going to disappoint. Everybody is going to be looking for some kind of weather-related improvement because everybody believes that the only thing restraining the economy in the first quarter was the weather. Since it wasn't the weather, it was actually the economy. As the economic data continues to come out negative, right, the Fed is going to be very worried about it. But I also believe the markets will continue to worry about weak data because it also means weak earnings. You know, there's an old expression among stock traders, sell in May and go away. Well, it seems this year they didn't want to wait until May. They're selling a month earlier and going away. And I think that selling pressure could continue, which again will put even more pressure on the Fed. Because now not only do they have to consider the weakness in the labor market, but they're also going to be considering the dampening effect on consumption as a result of a reverse wealth effect as bull markets turn into bear markets. And the main reason that I believe that this bear market will be cut short is because I do not believe the Fed will allow it to play out. I think before the market collapses, the Fed will come to its rescue in the form of more QE. If I didn't believe that, then I would be a lot more bearish on the stock market because the market deserves to trade a lot lower than it is trading based on the fundamentals. But I think the Fed is in and of itself a fundamental factor with its money printing. Also, we had a lot of crazy IPOs that came out last week, 5 of them on Friday alone. We've got a pretty busy calendar again this week. The one thing most of these IPOs have in common is they have no earnings. They have huge losses, and if they have any earnings whatsoever, they are tiny compared to the prices or valuations that are being assigned to these stocks. And this is very much reminiscent of the craziness that surrounded the IPO markets in 1998 and 1999 with the dot-coms. In many cases, these valuations are even more absurd than they were then, yet everybody is trying to justify why this time it's different, why this time the valuations make sense, that these businesses are real. Yet when I look at it, they're just as phony. It's just as much nonsense now as it was then, except it's the same old, this time it's different, right? Whenever there's a mania, whenever there's a bubble, the participants always say, yes, but this time it's different, because they have to. They can't say it's the same, because then they'd admit it's a bubble. But all bubbles are the same in that everybody believes that what they're experiencing is different. That's exactly what they said in the 1990 bubble. It was different then. It was a new era, right? They all agreed that it wasn't the same. Well, now they're making the same mistake again, and you got these Fed officials that are saying that they see no evidence whatsoever of a bubble. But of course, that's exactly what they said back in the 1990s. That's what they always say. They never see a bubble until after it pops. It's going to be no different this time. They're not going to acknowledge this bubble until long after it pops. To the extent that they do see it, I believe that they know that it's too big to pop. That is the problem. In the past, they've kind of thought, well, if there's a bubble, we'll deal with it after it pops. Now they have to acknowledge that if there's a bubble, it's so enormous that we can't let it pop because there's no way to deal with it. So we have to do everything we can to keep inflating it. I think part of that propaganda is the effort to convince everybody that the real enemy is falling prices and that the Fed's real mission is not price stability, but inflation. And I've talked on this video blog before about how they're trying to scaremonger us into believing that deflation is bad, that if prices go down, that the economy will collapse because nobody will buy anything, despite the fact that there is not a shred of anecdotal evidence to suggest that. In fact, all of the evidence shows the reverse, that falling prices encourage consumption, if for no other reason that falling prices mean that more people can afford to buy stuff. And if you can afford to buy it, you do. If you can't afford to buy it, you don't. And if you can't afford to buy a certain price, and if the price only goes up, well, then you really can't afford to buy it. But all of the arguments have been that deflation is bad. But now, for the first time last week, and I wrote a commentary about this on the Europac website, it's titled, Meet Lowflation, Deflation's Scary Pal, and you should read it. But I finally read an article where economists were arguing that the Fed has to create more inflation, not just as a safeguard against deflation, but because we need it. See, when they said that before, when the economists were saying that, we can't have inflation of just 0.5% or 1%, it wasn't that low inflation was bad. It was that it was too close to the danger zone, too close to falling prices, and that falling prices were so horrible that we needed to maintain a buffer just to have some extra insurance against falling prices. So we needed inflation of like 1% to 2% or maybe 2% just to provide a cushion to make sure that prices didn't go negative. But this is the first time I've read arguments where economists were saying, no, low inflation in and of itself is bad, that's a scary, dangerous thing. And so we have to do something about lowflation, right? And it's not stagflation or reflation. This is the new word that they've coined that we have to fear, and that's lowflation. And that's an idea that if prices aren't rising fast enough, then that's an economic problem. Problem for who? The only people or groups that suffer from low inflation are debtors that were counting on higher inflation to wipe out their debts. So yes, if you have a lot of debt and you want high inflation to wipe it out, well then if your inflation is lower than you expected, then that's a problem. But it's not a problem for creditors, and it's certainly not a problem for consumers. The problem for consumers is when prices go up, right? And that's the problem for savers, for creditors, is when the value of money goes down. But that's music to the ear of a debtor. And since governments are debtors, and since a lot of the speculators are debtors, they are beating the drum for inflation. And these type of articles, this type of economic, insanity is what is going to be providing cover for the central bank. So I think that with the weakening in the stock market, the softness we're seeing now in the real estate market, with the fact that we're going to be getting weaker jobs numbers in the spring that cannot be rationalized away based on the weather, the Fed is going to have to come forward at some point and acknowledge what should have already been obvious, that they were mistaken, that they were overly optimistic on their assessment of the economy, that for whatever reason, and maybe they'll come up with an excuse to try to save face, they can blame it on some external factor, but the Fed is going to have to come out and they're going to have to halt the tapering process and ultimately reverse it. How much time there will be between the pause and the reversal, I don't know. I don't think it'll be more than a couple of meetings at best. But that's what's coming. And where this is not expected is in the foreign exchange markets. Where it's not expected is in the precious metals markets. Gold is still positive on the year. It's doing better than stocks, but it kind of has been in a holding pattern really ever since the Crimea. It's funny how you see a lot of people trying to attribute the strength in gold this year to the uncertainties introduced by Russia in Crimea. Meanwhile, all of the strength in gold preceded that conflict. Ever since that conflict, gold has actually been lower and now kind of trending sideways, as has the dollar. But I do think when the world comes to terms with the true weak position of the U.S. economy and the fact that the Fed, far from being out of the game, is going to be even more involved, it's going to be doing even more QE. I don't know if they're going to have to call it, QE 5 or 6. I even lose count of where we would be. Or if it's just a continuation of QE infinity, just an acknowledgement that they can't end it, that they have to continue it, and they have to up the dosage, right? When that happens, I think that is going to be a catalyst for a much bigger move up in gold and silver and down in the dollar. Sure, it might stop the nominal decline in stocks if stocks continue to trend down up until that point. And yes, I think the market would reverse based on the Fed coming to the rescue, but it won't be as big an impact as it will on other asset classes. And I also don't think it's going to provide as much momentum for the momentum stocks, for these high flyer, pie in the sky multiple stocks. I don't think that they're going to have the same boost that they had from prior stimulus. I think the stocks that will most likely benefit from a upping of the monetary dosage will be more of the value, multinational stocks, the exporters, the commodity type stocks. I think they're going to take over the leadership from the NASDAQ type IPO, no earnings, lots of hype, right? No stake, all sizzle type stocks. Those bubbles may have already burst. Anyway, that's it for now. Don't forget, you get more frequent day-to-day updates, particularly on the market. I mean, if the market starts to behave more volatilely, we have more action, you want to listen to what I have to say on a daily basis. We talked a lot about the markets on Friday's show and again on Monday's show, on the Peter Schiff Show. So don't forget, it's schiffradio.com. The live show is 10 a.m. to noon every Monday through Friday. That's Eastern time. And if you miss it live, just go to Schiff Radio anytime you want throughout the day and listen to my thoughts. That's it for now. Take care, everybody.